Hello everyone and welcome back to the channel. Today we are diving deep into Chapter 3 of the ACCA Financial Reporting syllabus, IAS 38 Intangible Assets. This is a highly examinable standard that frequently appears in Section A, Section B, and occasionally forms a critical part of Section C single entity preparation questions. Whether you are looking to secure those crucial marks or master the accounting treatments, you are in the right place. In this masterclass, we will walk through the exact criteria, double entry implications, and high-yield exam tricks that you need to know. Let's get started. Let's start with the basics. What exactly is an intangible asset under IAS 38? By definition, an intangible asset is an identifiable non-monetary asset without physical substance. To recognize an item under this standard, it must tick three critical boxes. First is identifiability. This means the asset is either separable, meaning you can sell it, license it, or rent it out on its own, or it arises from a contractual or legal right, like a franchise license or patent. Second is control. The business must have the exclusive power to command the economic benefits from this asset and actively restrict competitors' access to those benefits. If you cannot control it, you cannot capitalize it. And third is future economic benefits. The asset must bring economic value to the entity. This isn't just about direct sales revenue. It can also come in the form of manufacturing cost savings or operational efficiencies. Now, let's talk about the technical rules for recognition. How do we put this on our statement of financial position? Under IAS 38, we only recognize an intangible asset if it is probable that future economic benefits will flow to us, and the cost can be measured reliably. At inception, the asset is always recognized at historical cost. This includes the purchase price and any directly attributable costs to make the asset ready for use. But what happens next? Subsequent to initial recognition, IAS 38 gives us a choice of two models. The cost model, which is cost less any accumulated amortization and impairment losses, or the revaluation model, which allows us to measure it at fair value. But pay close attention here because this is a classic ACCA trap. The revaluation model is only permitted if there is an active market for that specific intangible asset. In the real world and on your exam, active markets for intangibles are incredibly rare. You cannot use revaluation for unique things like brands or patents because they are unique and do not have active trading markets. Now, we arrive at the absolute core of Chapter 3, research versus development. The examining team loves to test this boundary because the accounting treatments are completely opposite. On the left, we have the research phase. This is purely experimental or investigatory. Think of laboratory research, testing alternative products, or trying to find new materials. Because the future economic benefit is uncertain at this stage, IAS 38 states that all research costs must be expensed to the statement of profit or loss as incurred. Furthermore, look at the center tile. This is what I call the gateway rule. Once research costs are expensed, they are gone forever. You can never reinstate previously expensed research costs as an asset in later years. On the right is the development phase. This is where we apply our research findings to a concrete plan or design to produce commercial products. Under IAS 38, development costs are capitalized as an intangible asset, but only if they meet a very strict set of criteria. So, what are these strict criteria to capitalize development costs? You must memorize the mnemonic PIRATE. All 6 of these conditions must be met simultaneously before you can stop expensing and start capitalizing. P is for probable economic benefits. You must prove there is a commercial market or a clear internal use that will generate future economic inflow. I is for intention to complete. Management must have a formal, documented intention to finish developing the asset so it can be sold or used. R stands for resources available. The company must have the technical, financial, and physical resources to actually finish the project. A is for ability to use or sell. The entity must have the practical capability to exploit the asset once complete. T is for technical feasibility. It must be scientifically possible to complete the asset so that it is functionally ready. And E is for expenditure measurable. We must have a reliable costing system to track and measure the development costs specifically. Remember, in the exam, the moment all 6 are met is the exact date you start capitalizing. Any development costs incurred before this date must be expensed and cannot be written back. Once our asset is successfully capitalized, how do we treat it over time? This depends entirely on its useful life. If the asset has a finite useful life, we must amortize it systematically over that period, typically using the straight line method. But here is another vital exam detail. Amortization begins when the asset is available for use, not when commercial production or sales begin. Watch out for dates in Section B scenarios. For the residual value of intangibles, we assume it is 0. The only exceptions are if we have a contractual commitment from a third party to buy it, or if an active market exists to determine a resale value. If an intangible asset has an indefinite useful life, we do not amortize it. Instead, under IAS 36, we must perform an annual impairment test to ensure its carrying value does not exceed its recoverable amount. You must also review this status every year to see if the indefinite life assumption is still valid. Let's summarize the most common traps and focus areas where ACCA candidates lose marks. First, prohibited capitalization. Under IAS 38, internally generated brands, mastheads, publishing titles, and customer lists can never be recognized as assets because their cost cannot be separated from the cost of developing the business as a whole. The same applies to staff training costs. You cannot control human capital, so train expenses are always charged to profit or loss. Second, watch out for the amortization split. In exam questions, they will give you a list of expenses. Be sure to exclude administrative overheads, general marketing costs, and operating losses from the asset cost. Only direct development costs can be capitalized. And third, group context. If a parent company acquires a subsidiary, any brand name or customer list acquired is valued at its fair value and capitalized on the consolidated balance sheet. This is true even if the subsidiary had internally generated that brand and expensed it in its own single entity accounts. And that wraps up Chapter 3 on IAS 38 Intangible Assets. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit the notification bell so you never miss another ACCA Financial Reporting class. Now, it's time to practice. Go straight to your BPP or Kaplan study kit and try the objective test questions on IAS 38 to lock in this knowledge. If you have any questions or tricky past paper scenarios, leave them in the comments below and I will be happy to answer them. Thanks for watching, study hard, and I'll see you in the next masterclass.